Hi there. I'm Jason Ayers, founder and president of OptionsSource.net, and thank you for joining us to learn how you can gain market exposure using SXO options. In most cases, investors will select individual stocks in order to build a well-diversified portfolio which will follow the movements of the overall market. This traditional approach can be replicated with the use of SXO options. The use of SXO options offers the same level of diversification as a portfolio of stocks. However, it can be established at a lower cost because fewer transactions are required. It also offers greater leverage because the premium of an option is only a fraction of the actual share price. Moreover, SXO options give investors a limited risk exposure. Option selection will depend on the forecast of the investor. Therefore, depending on the market outlook, investors would purchase a call if a rise in the market is anticipated. Conversely, a put option would be purchased if instead a decline in the market is expected. It is important for the investor to select the appropriate expiration month based on their outlook. The selected expiration month should be based on the time frame in which the increase or decrease is expected to take place. An investor who has short-term expectations may purchase an option with a closer expiration date. Short-term options are cheaper based on the time remaining until expiration. On the other hand, long-term options allow for more time for an anticipated move to take place. Because of the considerable amount of time remaining until expiration, these options are more expensive. Remember that if the option does not move in favor of the investor by expiration, the option will have no intrinsic value and it will expire worthless. Once the expiration month is selected, investors must evaluate how big or small of a move they expect. The strike price of the option represents the level of the index where the investor has the right to buy or sell the underlying. The selected strike price should be based on the magnitude of the anticipated movement in the price of the underlying. The investor will materialize a gain only if the option has intrinsic value at expiration. If the option has no intrinsic value, it will expire worthless. To reflect intrinsic value, the index value must be above the strike price of the call option or below the strike price of the put option. Option prices are based on the probability of being profitable. Therefore, the closer the option is to having intrinsic value, the more expensive it will be. Options will fall into three categories based on the relationship between the strike price and the underlying value of the index. An in-the-money option has intrinsic value and will therefore be more expensive. Remember that the total premium of an option corresponds to the sum of the intrinsic value and the time value. At-the-money options have no intrinsic value. The premium is composed entirely of time value. However, these options will be relatively expensive because of the probability factor. Since the price of the underlying could very well be above or below the strike price at expiration, there are still great chances of the option being profitable. Out-of-the-money options have no intrinsic value, and because the strike price is further away from the actual index level, these options have a high probability of expiring worthless. They are therefore less expensive than at-the-money or in-the-money options. Let's now look at examples of investors who wish to gain market exposure under various market conditions. First, we will assume a scenario where the investor is expecting the S&P/TSX 60 to rise. In order to participate in the bullish move, the investor would buy SXO call options. In this example, the S&P/TSX 60 is at 680. At this point in time, the investor believes that there is upside potential over the next 3 months and chooses to buy a call option. He selects one at-the-money 680 strike call option with 3 months left until expiration. The premium is listed at $32. To determine the cost, the investor must multiply the premium by 10. In this example, the cost of one contract is $320. This table reflects the value of the call option contract at expiration based on various S&P/TSX 60 levels. Note that the investor risks losing the entire premium if the index settles anywhere at or below the call strike price on expiration. However, the most at risk is the initial premium paid. To determine the break-even point of the position, the cost of the premium must be added to the strike price of the call option. The investor will profit on expiration if the index closes anywhere above this break-even point. In this specific example, if the S&P/TSX 60 is above 712 at expiration, the investor will make a profit. Otherwise, the position will settle at a loss. The investor would lose the entire $320 premium if the index settles at or below 680. Let's now look at another scenario. This time the investor believes that the S&P/TSX 60 will drop and therefore chooses to buy put options in order to take advantage of the bearish market trend. Remember that as the S&P/TSX 60 decreases, the SXO put options will increase in value. At the time the investing decision is made, the S&P/TSX 60 is trading at 680. The investor chooses to purchase one 3-month at-the-money 680 strike put for $37. The premium is then multiplied by the contract multiplier of $10 in order to obtain the total cost of the contract. The full premium paid to acquire the contract is $370. This table reflects the value of the SXO put option contract at expiration based on various S&P/TSX 60 levels. Note that the investor risks losing the entire premium if the index settles anywhere at or above the put strike price at expiration, which is the inverse from the call option example we looked at earlier. However, in both cases, the most at risk is the initial premium paid. To determine the break-even point of the position, the cost of the premium must be subtracted from the strike of the put option. The investor will profit on expiration if the index closes anywhere below this break-even point. In this specific example, if the S&P/TSX 60 is below 643 at expiration, the investor will make a profit. Otherwise, the position will be settled at a loss. The investor would lose the entire $370 premium paid if the index settles at or above 680. Different scenarios can occur at expiration. First, if the investor's forecast materialized, the options will be in the money at expiration and will automatically be exercised. Remember that no shares will exchange hands. The contract will be cash settled in Canadian dollars. If, on the other hand, the investor's forecast was wrong and the S&P/TSX 60 moved in the opposite direction, an out-of-the-money option will expire worthless. The investor would therefore lose the premium initially paid to acquire the option. Alternatively, the investor could simply close the position before expiration in order to lock in profits or limit losses. This transaction can be done anytime prior to market close on the last trading day. Another possibility involves the investor rolling the position. Let's assume the investor was right about the direction, but maybe the move is taking longer to occur. If this is the case, the investor could elect to roll the position. Rolling a position implies closing, or in this case selling, the existing position and simultaneously purchasing a new contract with a further expiration month. If the expected amplitude of the movement in the underlying differs from the original forecast, the investor can not only select a contract with a further expiration month, but also a different strike price that will better suit their current market outlook. Finally, here are a few things to keep in mind when trading SXO options. First, remember that the option buyer can close out the position any time before expiration to lock in a profit or to cut a loss. The last trading day of SXO options is the day before the actual expiration date, since the settlement value is determined by the opening level of the index on expiration. However, if the option buyer elects to hold the contracts through expiration, no shares will exchange hands. The position will either expire worthless or be cash settled in Canadian dollars based on the intrinsic value of the option. Thank you for joining us.